Accounting and financial reporting for leases. What is lease accounting? The way a lease is recorded on each financial statement differs based on whether you're the lessor, you own the asset and are receiving payment from the lessee, or the lessee, you're paying to use the lessor's asset. When recorded correctly, these three documents provide a clear picture of the value of a company's assets and the impact the lease has on its overall financial health. There are two lease classifications, operating and financing, that determine how your company should account for its leases in financial statements, depending on the length of the lease term. Operating leases vs. financing leases. Operating leases. Operating leases are leases that don't present an opportunity for the lessee to gain ownership of an asset. For an operating lease with a term equal to or less than 12 months, the lessor reports the individual lease payments as income on the income and cash flow statements. The lessee reports the individual lease payments as operating expenses on the income and cash flow statements. For an operating lease with a term of more than 12 months, the lessor reports the lease as an asset on the balance sheet and individual lease payments as income on the income and cash flow statements. They must also account for the asset's depreciation over time. The lessee reports the lease as both an asset and a liability on the balance sheet and reports individual lease payments as expenses on the income and cash flow statements. Financing leases. Financing leases, formerly called capital leases, are leases in which the lessee has reasonable expectation to gain ownership of an asset. Under the United States Generally Accepted Accounting Principles, US GAAP, there are 5 criteria, only one of which needs to be met for a lease to be considered a financing lease. The lease transfers ownership of the underlying asset to the lessee by the end of the lease term. The lease grants the lessee an option to purchase the underlying asset that the lessee is reasonably certain to exercise. The lease term is for the major part of the remaining economic life of the underlying asset unless the commencement date of the lease falls at or near the end of the economic life of the underlying asset. The present value of the sum of lease payments and any residual value guaranteed by the lessee, not already reflected in lease payments, equals or substantially exceeds all of the fair value of the underlying asset. The underlying asset is of such a specialized nature that it's expected to have no alternative use to the lessor at the end of the lease term. For financing leases, regardless of the term length, the lessor reports the lease as a leased asset on the balance sheet and individual lease payments as income on the income and cash flow statements. The lessee reports the lease as both an asset and a liability on the balance sheet due to their stake as a potential owner of the asset and their required payment. They also report individual lease payments as expenses on the income and cash flow statements. Old vs. New lease accounting standards. A financing lease, which was called a capital lease at the time, had different criteria than those stated above. Previously, it was standard that no operating leases were reported on the balance sheet. To avoid having to report capital leases, lessors would skirt the criteria of a capital lease, for instance, cutting it as close as possible to the 75 and 90% benchmarks, and make it look like an operating lease. This is because keeping those leases off the balance sheet would reduce tax liabilities. Now, all leases with terms greater than 12 months regardless of classification must appear on the balance sheet. Why is lease accounting important? It's important to understand the ins and outs of lease classification and stay up to date on the current lease accounting standards. You also need to know how lease accounting fits into each financial statement so you can base decisions and strategies on accurate financial information. Whether your company is the lessor or the lessee, the way you keep track of assets, liabilities, income, and expenses generated by leasing activities will have an impact on the overall picture of your company's financials and, as such, its strategy.